Well, hello everyone. It's Travis Cadman here, and I want to welcome you to our multifamily investing webinar. We've got some great information on this webinar today, and I think that our team just did a great job putting it together. And we're going to cover some pretty in-depth information today. We're going to talk about what it takes to invest in multifamily apartment buildings, some things you should be looking for. We're going to talk about some economic trends and some demographics, and we're going to talk about maybe the path that you need to go down to actually invest into multifamily buildings. You know, we feel it's really our job to provide you accurate information with regards to real estate markets and trends, and really provide our members what we feel are the top investment markets today. And I think that, you know, not to toot our own horn, but I think a lot of you remember, you know, in 2009 when we said, hey, the place to invest if you want to participate in single-family homes is Phoenix, Arizona, and I think we've got some pretty happy investors out there today. And again, it's not to toot our own horn. I just think it's kind of a testament to our team and what we do as an organization with providing, you know, really solid information and education for our members, and we're pretty proud of what we do. So I think today what I'm going to do is I'm just going to show you exactly how I obtained my own success in real estate, just by really following a simple formula designed by us. It's from the ground up. It's what we use day in, day out. We've been using it for over 30 years, and of course we've tweaked it as time has gone on, but it's what we use, and we're going to share that with you with today. You know, we've got just a great turnout on this webinar today. I'm really impressed with how many people are actually on this webinar today, and so we're going to try to move through it as quick as we can. Some of the information we're going to cover is fairly deep. Some of it's a little dry, so take a drink of water, maybe do a little stretch while the webinar is going on so you can stay with me. But but we're excited about it. We're going to cover lots of information today. So again, thanks everybody for joining in, and feel free to use your index that's popped up on your screen there, and feel free to ask us any questions that you want. And if you want to right now, if you guys just want to test it, you can go ahead and do it. And you know, you can stick up your hand and say I'm here, or you can say this is a test or hello, just to make sure you know how it works. But and I can see questions are already starting to come in that people have, which is great. Go ahead, type all your questions in. I'll get through as many as I can, time permitting, at the end of the webinar. Any questions I can't get through, I'm just going to go ahead and we're going to send you an email following the webinar. But again, everybody, thanks for joining. So today, what we're going to do is we're going to cover a few things today, and we're going to cover basically the points you see on the screen. So we're going to cover types of multifamily investments. There's a few different asset classes under the multifamily umbrella. We're going to talk about those. We're going to talk about why multifamily, how to select a market. We're going to talk about some of the tax advantages with investing into income. So we're going to kind of break that into two parts. We're going to talk about sheltered income and equity growth. So we're going to talk about some of the opportunities that are available there. We're going to talk about some unique and profitable benefits available only to real estate investors. You know, real estate is really kind of a unique asset class for investing into, and it has some unique benefits. We'll talk about some of the long-term fundamentals that will drive multifamily for 20 years. This is some good data that I think you can use in your toolbox to help you make some decisions. And then we're going to talk about 3 tax strategies used by the wealthiest real estate investors. And again, those are only available in the real estate asset class. And then we're going to finish it off just with some 7 key requirements for successful multifamily investments. So kind of a roadmap, if you will, to kind of walk you through the process to actually, you know, get started investing in real estate. But before we do that, I'd just like to take just a moment and talk about some of the people that are actually behind Investar USA and behind some of our individual markets. And I'd just like to just kind of give you a little warm up to that. Myself, I'm Travis Cadman. I've been in the real estate business for about 30 years, and to date I've been involved in close to $1 billion in real estate transactions in both Canada and the U.S. You know, my past has taken me into various aspects of the real estate space. I've been involved in land banking, land development, residential construction, both on the single-family and multifamily side, condominium conversions, mortgage investments, and of course distressed asset investments. And we were pretty heavily involved in the Phoenix market from 2009 to 2012, and built up a pretty nice portfolio there. And I know some of our investors did really well, and they're still doing well from the cash flow. And I think I'd have to say that through all of my career to date, the most fun and reward I've experienced is really with buying and holding both single-family and multifamily properties. And honestly, you know, when you look at the risk versus reward, it's really tough to beat buying well-selected cash-flowing bricks and mortar. And with today's housing metrics, I'm extremely bullish on the U.S. multifamily market. And you know, it's really kind of that sustainable income that I'm looking for, and I get that through, of course, you know, the single-family portfolio I have as well as the multifamily. Michael McGrath has began his profession in real estate actually in 1977 as vice president of a Houston-based Texas Capital Management Corporation, and he was responsible for acquisitions, management, and leasing investment properties for a major California investment firm. Michael formed Asset Campus Housing to specialize in the operation of student housing and has grown the company to the largest privately owned management company in the nation with over 60,000 units under management. And over the last 28 years, Michael has been involved in the analysis and operations of several $1 billion of real estate investment properties. Ryan McGrath, he works in corporate planning and investment for one of the largest multifamily property management companies in the United States. Prior to his start in the multifamily space, Ryan worked in the investment banking division of Goldman Sachs. And Stephen Mitchell, he oversees our Houston property management operations, which include on-site management, service technicians, you know, marketing, investor reporting, and strategic planning. And over Stephen's career, he has participated in sourcing and financing disposition of real estate transactions in excess of $8.5 billion. So he's done a lot of work in this space, and we're proud to have these guys on board, and they're doing a great job for us. Investar USA, you know, we've been involved in real estate for many, many years, both in Canada and in the U.S. We've got just over $100 million in commercial real estate under management. We've been in the individual investor space and also in the portfolio management space for quite a long time. I got a lot of transactions under our belt, and we tend to acquire, you know, right around $20 million in new assets every year. And we've got a large family of investor clients, both from a domestic and international perspective. And under my own bio, I know I talked just a little bit about some of the things we've been involved in the past, and you can see on your screen, you know, there's a number of different asset classes that we've been involved in. And but you know, our focus, you know, moving forward is really in that bricks and mortar space, in that multifamily housing space, and that's where we've done really well, and I know some of our investors have done really well as well. Now, when we talk about the types of multifamily, you know, when we talk about multifamily, sure, it's multiple units, maybe under one roof or in a project, but really we kind of break it down into a couple different categories. You know, of course, we've got the straight, you know, multifamily residential. Typically, that's your 2 to 4 unit buildings, and it could be in the form of a duplex, a triplex, or a fourplex. And then, of course, we've got the, you know, the medium or the small apartments, and that's in the 5 to 70 unit space. And those ones there, you're still hands-on because you're still under 70 units. So as an owner, it's tough to kind of go with that third-party property management company. Even though I know some investors do it, it just lowers the return slightly. They're still seeing some good returns. It just lowers the return slightly, and there's definitely some opportunities in that space. So we call those small apartments if they're in the 5 to 70 space, and then of course we get into the you know, the larger commercial multifamily, and we get into the 70 to 300 units plus, and mainly the investors investing into those buildings are individual investors, private investment companies, REITs, AAA rated life insurance companies, and we tend to stay closer to the 70 to kind of 200 unit range. And the reason why we do that is, you know, quite frankly, it's easy for us to buy you know, 70 units as it is 10 units. So we really we focus there. But the big reason why is economies of scale and efficiencies. And that's why is because you can have, you know, the third-party property management company, you can have an on-site full-time manager, you can have an on-site full-time service technician looking after the needs of the tenants and making sure that they're happy. And when you go into the smaller units, you know, below 70, it's tough to do that from a numbers perspective. I'm not saying you can't do it, it's just tougher to do it, but we tend to stay in the 70 to kind of that 200 unit space. We'll talk a little bit now about why investing in multifamily, and I'm sure, you know, that a lot of people on the call today or the webinar today, know there's advantages to investing in multifamily. So what I'm going to do is I'm just going to kind of go and pick off the kind of the high points. I think the first thing is it's always in demand. We're talking about kind of a shelter product, so it kind of falls under that necessary need of food and shelter. We're in the business of providing affordable housing, which always has been and always will be in demand. The next thing is we're kind of a recession-proof investment. When we enter into a cyclical market downturn or recessionary times, we're not affected in the apartment asset class we invest in. I got to emphasize we invest in because we're investing in B and C class apartments, and they tend to weather the storm a lot better than, say, maybe an A class apartment would. But again, we're recession-proof because we're investing into housing, but more importantly for us, we're investing into affordable housing for our residents. And this was really clearly proven in the most recent recession we just had. And our actual vacancies decreased as more demand was put on rentals because obviously people were getting out of home ownership or losing their houses to foreclosure and that type of thing. But really put a lot of pressure on our vacancies. They went down, and of course we saw upward pressure on rents as well. The next thing is we feel that we're in the inflation hedging business by investing in multifamily. We're investing in bricks and mortar, existing buildings, and as prices rise, so are our property values. So that's a good thing. So as the properties as cost of goods rise, so does our properties, and so does typically our rents. With multifamily buildings, in most cases, not all, but most cases, you're able to get leverage or bank financing, and of course. This is one of the few investments that banks will actually lend you money on to invest, and so they kind of invest alongside us, and we're seeing leverage that's anywhere from 50 to 75% depending on the asset. The next thing is tax benefits. Real estate is known for its tax benefits, and we'll be talking a little bit more in depth on this exact topic further in the presentation. The next thing is professional property management. We are typically involved in medium to large projects, so we always have professional third-party property management, thus leaving the day-to-day running of the business to industry professionals. Our projects always have at least one on-site full-time leasing manager, kind of a leasing/operations manager, and one full-time service technician. And our service technicians are always AC certified, and that's a requirement that Investar has just because we're typically down in those Sunbelt regions and all of our units have an air conditioning component, and we just want to make sure that we cut down on our third-party service calls to our AC service contractors, and we try to take care of as much as we can in-house. The next thing is with real estate, of course, we typically like the appreciation, and typically we get the appreciation over the course of time. And real estate will always go up in value over the course of time. We just look at what you paid for your house, or maybe what your parents paid for their home, and you can see what I mean. What they paid for a house back in 1970 or 1980 or 1990 for that matter, and what's that exact same house worth today? And so real estate over the course of time will always go up in price. So sure, there'll be peaks and valleys and things like that, but it'll always go up over the course of time. Now, with multifamily, our focus is on rent growth and increasing our net operating income, or NOI. And again, over the course of time, rent will increase, and ultimately our net operating income will increase as well. Investar USA has a value add program whereby we improve certain aspects of our complexes to achieve a higher rent, thus a higher net operating income, thus providing us with a great appreciation advantage. We're going to talk about our value add program and exactly what do we do to a building from a value add perspective to make it more there more value for the tenants, and of course increase our cash flows, thus increase our values. The next thing is, of course, cash flow. Well-selected and well-managed properties can produce positive cash flow. Again, we will dive into this topic further in just a couple slides. On the value add side, we touched on this just moments ago, and value add is where we do very specific improvements to a property that creates additional value for our tenants, thus providing us additional rental income. The things we do to our property are quite extensive and involve both the common areas such as pools, landscape areas, and rec rooms, common areas, and also upgrades to the actual units that make our value add program such a benefit to both our tenants and us as owners. And the next thing is refinancing ability. This is simply a fantastic tool, and we'll be discussing this in more detail in just a couple slides. And historically, multifamily has been the safest real estate asset with the lowest risk and highest Sharpe ratio, which is really your risk-adjusted returns for the last 100 years. Economic cycle resistant, can generate yield in almost every market environment. So these are just a couple of the main points why invest in multifamily, and we could go on and on and on and talk about another 20 or 30 reasons why. But yeah, these are kind of the hot buttons as far as why invest in multifamily and why so many people are in the space and why so many people are actually coming to the space today. The next thing I'd like to talk about is how to select a market. And when we talk about how to select a market, we're going to go through a couple slides on this, but first and foremost is when we look at a market to invest in, the first thing that we look at is population growth. And so if you see the chart to the left-hand side there, you'll see that this is from the U.S. Census Bureau, so we don't have like numbers as of today, but the trend still holds true with what we're seeing here on the screen. So we talk about population increases. Of course, New York is leading the pack by a long shot, but one of the real strong markets is Houston, Texas, which we're really bullish on for a number of reasons, and we have a separate webinar we're doing specifically on Houston. But in our opinion, Houston, Texas is probably one of the strongest markets to invest in today in the multifamily space in the nation. Seen some tremendous population growth. And if you look quickly to the right there, you'll see some real positive job growth as well. Los Angeles has always been a strong, strong on the population increase side. San Antonio, Texas, and Austin, Texas. So out of the four strongest population growth markets, Texas accounts for 3 of the 4. And so, I think it says a lot for what's going on in Texas. The next thing that we look for, in addition to population growth, is job growth. We look for markets where there is actually job growth. And the reason why we do that is because it means that the economy is performing well. Things are happening. Employers are hiring employees, and we like that because those employees are our tenants. And so we really like that. So when you look across the U.S. at the strongest job growth markets, and you look at some of the markets that have come out of recovery from the recession, and you can see some of the top performers there. Houston, number 1 position, Dallas, number 2, Washington, 3rd, Boston, 4th, and New York, 5th. And so this kind of shows you where's the population growth, where's the job growth. And the next thing we look at is affordability. So if we know a market has positive population and job growth, we also want there to be affordability within that market. We're not looking to buy apartments that are, where the rents are $3,000 a month for our tenants. We're not investing in New York. And so we're still in the affordable price bracket. And we like the average American renter, and that's our bread and butter, and that's really who we've kind of honed the niche into catering to. And so we're like the affordable markets. We like affordable single-family homes. We like affordable rental properties, and so we look for affordability within that market. And we like to be in markets where the average homeowner ratio is about 60 to 65%, and that's a good recipe for us. The next thing is we look at market cycles. And so when we choose a market, we want to be coming into a market at the bottom, or just coming out off the bottom and going into a steep increase in their rental increases and in appreciation. Sometimes we'll enter a market as it's still kind of on that downward slide, and you saw us do that in Phoenix. But we knew we were okay when we were seeing 9+% cash-on-cash returns. We knew that the bottom was near, but we didn't really care though, because we were making the cash-on-cash returns no matter what. But we knew the bottom was near because we were so far overcorrected and so far below replacement cost. But market cycles is important, so you can kind of see the graph to the side there. We kind of buy at that stage 1, the bottom, and the stage 2. That's kind of where we enter into the market, and that's where we are right now in Houston. The next thing is no rent controls. We don't like limitations on what we can do with our buildings, what we can do with rents. So we're investing into markets where there is no rent controls. The next thing is trade availability. Obviously, we are turning over units as tenants leave. We improve the units and have nice fresh units for people to move into. We don't want any problem in getting the trades in there to make that happen, because it would impede our rentability of that unit, thus affect our cash flow. So we need an abundance of trade availability. We need strong property management and business-friendly local and state governments. So those are really important to us. And so those are what we look for when we look at markets to invest in. Now, we're going to take a second. We're going to talk about tax-sheltered income and equity growth. And really what I'm going to do is I'm really going to focus here on three primary tax strategies. Now, the first thing that we're going to talk about is we're going to talk about depreciation, and then I'm going to talk about accelerated depreciation. So depreciation, I'll explain that. When we buy a building, we conduct a cost segregation study, and everybody, if you don't do that, you should do that. Because what you need to do is as soon as you buy the building or when you're in the process of buying it, you need to understand, you know, how much are you paying for the building versus how much are you paying for the land. And what we were able to do in real estate is we're able to depreciate the building cost over the span of 27.5 years. And that's what the IRS, and I believe it's Revenue Canada as well. Up in Canada, I think you can do that there as well. But the U.S. for sure is 27.5 years. So we're able to depreciate our actual building cost, not our land, because land doesn't depreciate. There's nothing on there that wears down. But we're able to depreciate our buildings over the course of 27.5 years and get a nice deduction from our taxable income. So let me give you an example. Let's say that we all got together and we bought a building for $1.5 million. And the actual building value was $1 million. Thus, you paid $500,000 for the land. And we use the 27.5 years that the IRS allows us. We're able to reduce our taxable income by just over $36,000 per year, but you still get the money in your pocket. So if let's just say that your taxable income at the end of the year for your building was $36,000, and that's how much your taxable income was. Well, when you take into consideration your depreciation, which the IRS allows you to do, you reduce your taxable income by $36,000, so the amount that you pay in tax is zero. How fantastic is that? But yet you still got the $36,000 to put into your pocket, leave in the business, or go and use it as a down payment on another property or another investment. So it's a fantastic tool that we use day in, day out. Now, accelerated depreciation just advances that entire process that much quicker. So what we're able to do is we're able to take smaller items such as office equipment, laundry equipment, you know, the washers and dryers, our legal fees, closing costs, and we're able to deduct those over the course of 3 to 5 years, not the 27.5 years. So we're able to take those deductions in the first 5 years. So what happens is when you invest in these buildings, your depreciable expenses are greater in the first 5 years than they are for the full 27.5. But it's great. Take it because it's going to be putting some tax-deferred money into your pocket. Now, the next thing we'll talk about is tax-free refinancing. And basically with your property increasing in value and your mortgage getting paid down, because tenants like to pay down your mortgage for you, that's part of the reason why we like the multifamily business, your mortgage is going to get paid down over the course of time, and we have the ability to refinance every 3 to 5 years and pull some of that money out that we've made in capital appreciation. And through this process, you as an investor will not be taxed on the amount you received that was delivered or derived from this refinancing process. So it's just truly another great benefit of investing in real estate. And the next thing is sell and perform a 1031 exchange. Now this technique is not available in Canada, only in the US, and I got to tell you, it's just a fantastic tool if you're looking to buy and sell, buy and sell, buy and sell, and have some definitely tax-deferred capital gains. So with a 1031 exchange, what it allows us to do, it allows us to sell our apartment building and roll over all of our profits. So if we bought a building for $1 million and we sold it for 1.5, we have $500,000 in capital gains. Well, if your intent is to continue on and you like this business of you know, buying and fixing and selling multifamily buildings, and you want to move on and do it again and again and again to duplicate your process over, you can do it, and you open up a 1031 exchange every time you enter into a sales contract in your building. And what happens is you put your profit into the 1031 exchange account, and then you get into another like asset purchase, and you pay no tax on the gain. And it's a fantastic opportunity to actually have deferral on your capital gains tax, and this can go on into perpetuity. You can do it for years and years and years, and this tool has been around in the U.S. for quite some time, and a lot of high net worth individuals, institutions use this advantage in the U.S. because you pay no tax on your capital gain, and just a great opportunity to have some tax deferral on your capital gain. So now what I'd like to do is I'd like to talk about 4 unique and profitable benefits that are really only available to real estate investors. And of course, the first one is going to be cash flow that we're going to talk about. Now with cash flow, of course, you've got monthly or quarterly net income from your property, or at least I hope you do. And the next thing is, of course, the growth, and your cash flow is derived from your gross rents less your operating expenses, capital improvements, and debt. And really, from a cash flow perspective, we're seeing returns anywhere from that 5 to 9% range on an annual basis for the B and C class assets, and that's really what you should be getting on your cash flow. The next thing is appreciation, and of course, this is the increase in the value of the property through increases in net operating income or capital improvements, or a combination of both. Now, appreciation, it's going to be realized at a property sale or refinance event. And typically, the largest gain on a transaction is through your appreciation. And through this process, you can safely achieve anywhere from 6 to 10% just on appreciation alone, with a 70 to 75% loan-to-value property. The next thing, advantage we've got in real estate, of course, is principal paying down your mortgage. And so, the monthly benefit to investors from reducing the loan balance, it's only realized at a property sale or refinance. And typically, a principal paydown will account for about 3 to 4% of an annual benefit per year on a property that's leveraged to 70 to 75%. And it's just a great thing when tenants want to pay off your mortgage for you, and that's one of the beauties of being in real estate. And the last major advantage to us, of course, is our tax benefits, and we'll talk about that in a little bit more detail. But real estate is really one of the most tax-advantaged asset classes. I think oil and gas has some good advantages, and I think farming as well. It's just they're tough to tap into to take advantage of. And with real estate, you can get some tax-free income. You can get some tax-free refinance capital back to you, and you got some tax-deferred capital gains that we talked about. And really, when you look at real estate, there is just so many tax advantages to investing in this asset class that really, with real estate, our worst case is really, in a lot of cases, it's the best case for other asset classes. So it's something that you really need to look at and understand, because it could assist you in whether or not you participate in this asset class. But and with regards to taxes, we're not tax professionals. Like, we've been around the space for a long time, and we kind of have the ways that we invest, and based on how our consultants say we should structure our deals from a tax perspective. But I really got to put a caution flag out there and say you really need to get your own tax opinion, because everybody's situation is just a little bit different. And so before you invest, we strongly recommend that you have somebody just take a look at it from a tax perspective as it relates to you. So if you're looking to invest, are you going to hold your investment personally? Are you going to hold it in a corporation? Are you going to hold it in an LLC? Foreign investors, you're going to want to have a quick, foreign tax consultation, just to make sure that, you're not going to be put into a situation where you're paying double tax. And so it's just really important that you get your own tax advice. Now, with real estate, you can really shape your return to your objective. Now, if you're strictly looking at maximizing cash flow, you would look at a higher yield deal. If you're looking for more capital appreciation, you'd be looking at more of a kind of a value add play, where you can actually buy something, fix up the common areas, fix up the units, and then sell it. Maybe that's more of a capital appreciation play you're looking for, or maybe you're looking for a combination of cash flow and capital appreciation, which is really kind of right into our wheelhouse. And you'd be looking for, a leveraged deal with a value add component. So there are a number of ways with multifamily to kind of shape your returns. And this, again, is a number of reasons why so many people right now are turning to this asset class, because it gives them a lot of flexibility. Now, with stocks, which is more liquid and transactional, you'll have the ease of being able to cash out. However, you don't have the advantages, the tax advantages, and quite frankly, returns that you can get through well-purchased, well-managed, well-located real estate. The 15 to 18% returns we're talking about are backed up by the National Association of Commercial Real Estate Investments Funds, which is NACRF. And the returns we are talking about here are typical, if done properly with the right, with the right sponsor behind you, the guys that know what they're doing day in, day out. With the stock market, I believe the average annual dividend, including reinvestment, is between 6 and 7%. And so I think for a lot of people, it's just really about getting access to the investment and being able to get into the space. Now, we're going to talk now a little bit about demographics and economics. And it's going to be maybe a little bit dry for some people, but this is really, really important. The demographic and economic trends that are lining up right now are some of the key reasons why we and some of the professionals in this space are lining up now to invest in multifamily buildings. These trends are 100% visible. They're very, very long in duration. They're not really sensitive to market swings and things like that. And when they start to turn, you'll see it years in advance and can be leveraged, within the multifamily space for years and years to come. And so I can't emphasize how important what I'm about to share with you is from a investing perspective, because this one I'm going to share with you is just some fantastic intel with regards to investing in real estate and some of the drivers why. So the first thing when we talk about demographics and economics, the first thing I want to talk about is multifamily demand. So multifamily is really driven by households, the population cycle. So as household growth increases in the U.S., or more specifically within a city or metropolitan statistic area, or MSA, the better in general multifamily will do. So we tend to focus not on boom-bust markets, but on markets that have a proven growth path, and the growth is sustainable. So we're really not looking for kind of those boom-bust markets. We're looking for steady population and job growth markets. Now, by investing in these population growth markets, we have a better advantage when it comes to apartment demand, appreciation, rental income growth, and buyer demand for our apartments if and when we decide to sell. So understanding where people are moving to and why is extremely important to us as real estate investors. Okay, so now renter household formation is running at about 1.8 million per year on average, and that's expected for the next at least 5 years. So new household formation is 1.8 million, just over 1.8 million per year. Now the apartment median the apartments going into service is about 235,000 per year. So that leaves a supply-demand gap of about 1.5 million per year. So I think you kind of get where I'm going with this. So you'll see from the graph that the renter household has been increasing and will continue to increase. Now look at the years 2010 through 2015, which of course we're well into now. You'll see that between 2010 and 2015, we have new renters. We have 9.1 million new renters, or approximately 1.8 million per year, and that does not slow down for a while. And I'll show you just in a minute here why. But this is very, very important to understand what we're talking about here. So we're talking about new renter household formation is required, for the population growth, is just over 1.8 million per year. New apartments coming into service is 235,000 per year. Well, tells you right there you have a huge supply-demand difference, and so of course that is an eye-opener. That's a huge clue for you investors out there to kind of see exactly what is going on. Now we look at multifamily demand and we look at some of the waves that are coming our way. The biggest reason why is because of the demographic collision of two very large waves. Now, this graph is supplied to us by the U.S. Census Bureau and shows us the two largest demographics in history, which are the baby boomers, and they're about 77 million strong. And then not the kids, but the grandkids of the baby boomers are called echo boomers, are another wave of about 77 million strong. Now the nuance here is that the largest rental group is those aged between 18 and 30, and the second largest rental group is those over 55. So let me repeat that again. When we look at this graph and we see where there's just two huge waves of population moving through the age cycle, it's right in our wheelhouse. Our largest rental groups are those between the current ages of 18 and 30, echo boomers, and the second largest rental group is over 55. So of course that's the baby boomers, right? And the over 55 rental group, once they begin to rent, they never own again. And of course lifespans are increasing with the population and increases in medical practices. The average lifespan in the United States is 78, and it's increasing. So it's a large cycle that will be very, very focused on living in rental communities, and it will last for a very long time. So this is a critical stat that we've got here that I wanted to walk you through, because it's going to have a big impact on rental. Now let's take a look at immigration growth. It's another really key trend we're seeing in the U.S., and it's continuing to grow. The U.S. population across the board, and of course not only are we seeing immigrants come in, but really what we're seeing is actually a double compound effect, because the immigrants are coming in and they're also having kids, so it's further accelerating our population. Now, this is not a socioeconomic story. This is actually more of a sociological story. You know, the United States is one of the last, if not the only, ownership culture country. We believe owning a home is a privilege, not a right. And really, in most every other developed country, not just the third world, but almost every other developed country, it's not. So you don't have people coming into the United States thinking, I need to own a home to be successful. They don't have that mentality. You know, we've developed kind of a subculture that you need to own a home to be successful. Well, honestly, that shine has faded over the last few years, and I think it's firstly due to the housing crisis, and our kids moving forward will be more reluctant to enter in home ownership after seeing what we've gone through both personally and as a country. So the home ownership is on the decline across the board, and you've seen that in the previous slide, and I think it's truly lost some of its shine. Typical home ownership right now is just over 60%, from 1994 to 2002. We saw momentum to increase home ownership, and this peaked at the top of the housing bubble in 05 and 06, and since then we have seen a gradual decline in home ownership that is partly due to the housing crisis and ensuing foreclosures. However, this is also impacted by more stringent lending requirements and a general push towards renting. And just so you know, for every 1% drop in home ownership, that means 1 million new renters have entered the market. So people either own a home where they live with family or they rent, and people typically don't want to live with family long, so renting is really what they're gravitating to. The U.S. home ownership rate is declining. More individual and couples and families are going back to renting, and that isn't going to change anytime soon. So there's a lot of steam, and momentum behind this push of going into rental. So and it's all demand. So when we talk about this, we're talking about demand, and it's a very powerful demand story. We haven't seen anything like it, and I think it's going to last for a real long time, for years to come. And so when we talk about, this is us talking, and really, it's not just us that are talking about this. It's you've got Forbes, Wall Street Journal, CNN, Bloomberg, CoStar. They've all been saying that multifamily will outperform every other asset class, period. And it has been. If you look at the REIT market, it has outperformed pretty much every other asset class. Private REITs have done even better, and they have a much longer tail to them. A REIT truly, though, is just a real estate flavored stock, and they are purchased really purely on expectations. But the fundamental yield is highly disconnected from the actual stock performance. So when you invest into a REIT, you're not really investing in real estate. You're investing into a stock that owns the real estate. And a REIT will only provide sector exposure, and so you're not really owning real estate. You don't, if you really want to take advantage of the inflation hedge and tax benefits and have long-term income, you really have to own the actual property yourself, or through fractional investing or a limited partnership type structure or something like that. But everybody out there now that has done the analysis, done the research, are saying, you know what, I think you really need to take a look at investing into real estate, specific to the multifamily space. So to recap this kind of last segment, which I think is huge, we've covered some very important demographics and economic stats and general information that is extremely valuable to know, as I think it'll impact your investment decision. These trends have been visible for years, and we have seen, we've been communicating this since about 2008. Some of the largest multifamily REITs, Avalon Bay, Equity Multifamily, UDR, they've all been looking at this story and have been positioning themselves for it for some time, because they could see the demographics and they could see it happening. And I just can't scream loud enough about the opportunity that is coming in front of us now. Now remember, real estate is local, so you just can't go out there and buy anywhere. It has to be the right market or the right MSA. But the underlying fundamentals are that you have a strong tailwind behind you, and you just need to select the right market and the right operator. So it's this data information that gets us really, really excited day in, day out. And like I said, we're pretty bullish on this asset class now. Now we talk about the most proven wealth creation tool, and you look at the largest wealth building source in the Forbes 400 is commercial real estate. We've just seen a lot of people in that space that are just loving real estate, and the next thing is 90% of the Forbes 400 retain their wealth through real estate investments, and if you should research it, because you'll just see how true that actually is when you actually do that research. Nearly all millionaires earn their first million through their own business or real estate investments. The wealthiest investors own commercial real estate, and the fundamentals favor multifamily for the next 20-plus years. And I know when I was young and I was in my teens, and I learned fairly quick to associate wealth with real estate, as everyone I knew that had money got their money either through direct ownership in real estate or from investing with someone who knew something about real estate. So at a young age, I knew at a young age I was going to be in real estate, because I associated real estate and being in real estate to having wealth. So it's just a very important thing to participate in, and I think take a look at. What I'd like to do now is I want to walk you through the steps we recommend you take to get started with investing in real estate. This process we have laid out in 7 steps that I'll kind of walk you through. I'll walk you through the 7 steps now, and it's not laid in stone that you have to follow these steps. It's just kind of a general guideline that we recommend that you kind of look at and you go through if you're looking to get into real estate. And so we're going to go through the 7 steps individually that you see on your screen here, and we'll get started with the first one now. The first thing is understand where your money's at today, and there's a lot of lazy assets out there. We call it lazy money, lazy assets, and it's investment capital that's not working for you. So that could be money that you've got in your savings or your checking account. It could be in your brokerage account. It could be in a qualified retirement account. It could be safe home equity. Maybe you got a bunch of home equity that you'd like to do something with. You have money sitting in your home. It's just sitting there. You just got to make sure if you're going to use that, it's got to be into a safe and secure investment. But it's money that's in your home. It's home equity you can actually do something with. Underperforming real estate. There's a lot of investors that came to us that had underperforming real estate and they wanted to sell it, or they had sold it and they wanted to move into something that was more cash flow. And look for global real estate return at least to 6%. If you're not getting at least 6% on your money, you should seriously be looking at other options, because it's important that your money's working for you. The next thing is planning. Really, what do you want to achieve? Are you looking for yield, like a monthly income to live on, or to fund really a life goal? Or are you looking for maybe equity growth, saving for a life event or a future purchase or a move? You may be looking more for equity growth. Or maybe you're looking for some sort of a tax shelter, growing wealth with reduced tax on cash or equity. Or maybe you're looking just strictly for wealth preservation. You're looking to save, beat inflation. Maybe you're planning for like a future transition event. Or maybe you're just strictly looking for some legal protection. But when you're looking at your planning, you need to understand exactly what am I planning for, what am I looking to achieve, and what am I looking to save for. And I think it's really important that you actually understand what is your specific objective. The next thing, of course, that you're going to look at is you're going to look at what are your investment options that are available to you that are out there. And I think you can look at private and public real estate investment trusts. You can look at REITs, even though I think that you could probably do better. You can be looking at limited partnership type structures. You can be looking at direct ownership, or you could be looking at being an owner or an active manager. Now, of course, being an owner or active manager is a little bit more labor intensive, but it could still be profitable for you. But it's a fair amount of work. You just got to make sure you really want to take that on. And if you do that, of course, then you're flying alone, and you don't have somebody that's actually been down that road, that's made the mistakes that they wouldn't want to make again. The next thing is a partner evaluation. I think it's really important that you know who you're getting involved with. Making sure that you kind of know what their strategy is, what their philosophy is, who are the principles behind it, what's their performance history, what's the growth forecast look like for your property, and what has their experience been in the space. I think those are very important things that you can't underestimate. The next thing is the investment evaluation. It's really important to understand, if you're looking to get into real estate, and you really understand, what's the deal review. You got to look at the market. Am I investing in the right market? Am I investing in the right asset class in that market? And why? Why is it the right market? Why is it the right asset class? And have the intel to be able to make those informed decisions. Then you got to look at the operations, because that's really the glue that keeps it all together, is who's actually running the day-to-day operations that's going to make it work. That's extremely important. What's the approach to the investment? What's the financial projection? And of course, what are the agreements that are going to pull this together? And if you've gone through the deal review and you say, listen, I like what I'm seeing, and I want to move forward, of course, then you move forward to the actual investment process. And what you'll do is you'll typically, in a lot of cases, if you want to participate, the one is you're going to get the investment package, and that could be like an executive summary. It could be a limited partnership agreement. It could be a PPM, which is a private placement memorandum, and then of course a subscription agreement. And then the next thing you need to look at is, how much am I going to invest? What's my investment contribution? And then once you pledge that, then of course we go right into closing, and then you'll be getting your reporting and communications both before, at close, and then after. And we'll talk about that just in a second. As far as the property tour goes, I think that if an investor is fairly confident in the market and the operator, you don't have to look at the property. I'd never discourage anybody from looking at the property, but if you want to, and you want to fly to the market, because a lot of times investors don't invest in their own backyard because there's better deals somewhere else. And so I think that if you want to go look at the property, yeah, by all means, go take the time and go look at it. But it's not required that you do that, so long as you're comfortable with the information that you've had to make your analysis and make your decision. And then of course you're just going to monitor and track, and see what it is, see how it comes together. And really it comes down to performance reporting. It's either going to be quarterly or semi-annual. Your distributions back to you, when are they coming? How are they coming exactly? How is the tax reporting going to work on an annual basis? It's really important that that's clearly defined. And then of course personal communication, with your investment, or if you got a property manager, or you're in with a sponsor and somebody knows what they're doing, what's that communication look like? How many times a year are they going to communicate to you, so you can discuss the investment, the property, what's going on? Are we on track? Are we not on track? And are we on budget, not on budget, and things like that? But it's really important that you understand from the front end, what does that reporting look like, so that the expectations are set right from the get-go. And so we went through kind of the step-by-step process as to what it takes to invest, and understanding exactly that process. And like I say, I think it's really important that you follow the 7-step process to make sure that you're totally aligned with your investment, with your property management company, or with the company that actually got you in the investment, so you can fully understand exactly the process, the procedures, the communication, and make sure it's all laid down. So just pretty important steps to follow. So we're coming to a close on the webinar. I know that we said it was going to be about 45 minutes, and we like to stick to our timelines, and I think we're just over. And we've got just a ton of questions that came in from some investors, and I see we got some people that referred to us as well, which is great. And so what I'm going to do is I'm just going to go through the top 2 questions, and then get into kind of wrapping things up. So the first question that I got is, where are you currently acquiring multifamily properties? And so the answer to that, Jim, thanks for the question. The first one is, the answer is Houston, Texas. That's really, we're bullish on Houston. And you know, if you look at Houston's got strong population and job growth. I think there's about 5.9 million residents in 2010. It's an increase of about 26.1% since 2000. It's leading all other major U.S. cities. It was crowned the top destination for young professionals, and in U-Haul's national migration report, Houston was the top city for personal relocations. So even U-Haul is saying that's where people are moving to. You know, in 2013, there was just over 100,000 new jobs in 2013. That's a 3.7% increase in total employment. And just as an FYI, like the nationwide employment growth, you know, was about 1.9%, and Houston was at 3.7. And Moody's projects 423,500 jobs will be created in Houston from 2013 to 2016. And you know, it's an energy-focused economy, and you know, rents are definitely pushing in that market for a lot of the reasons why we talked about on this webinar. So what you're seeing rental demand is outstripping supply, and so we feel quite confident there's going to be some upward pressure on rents. And the other thing is Texas in itself is, you know, is being a Republican state. It's business backed, and so it's really for the business guy. And even when you're in Houston, you can just feel the vibrancy, and it's on the move. And I think that right now Houston is undervalued. You know, we participate in the single-family home market there, and that treated us well. But the bigger play is the multifamily space, and we feel there's just a great opportunity there. Next question that came in is there opportunities that I can get involved in now? And I got to be cautious when I answer that question, because the reason why is because we're in we're governed by the Securities and Exchange Commission, so I can't openly talk about investments. I can't solicit investments until we ensure that I'm talking to somebody who's qualified to invest with us. So anybody who's interested in investing, just please, you know, call us, drop us an email. You can see it on the screen there, and then we can go through the qualification process, or you feel free to jump on our website, and you can go through kind of the invest side of it, and you can see that you can fill out kind of a questionnaire that we've got there, and kind of go through it and see if you qualify or not, and go through that process. You know, we love to hear your comments. We love to get your feedback on what you thought about this webinar, or if you have any questions, feel free to shoot it through to us. But if you could take 5 minutes right now and post a comment on Facebook.com, you can see the address there on the screen. You know, we'll send you an exclusive multifamily property checklist, and really it's an owner's guide for operating apartment buildings. And you know, what it would help you with, if you got this guide, it's kind of our own little internal checklist that we use when we're looking to buy an apartment building. And it'll just provide you just a number of things to think about, to look for if you're looking to buy a multifamily apartment building. So feel free to take a peek at that. And lastly, I just want to, from all of us here at Investar USA, I want to thank everybody for for participating and for joining us today, and taking time out of your day to kind of learn a little bit about multifamily investing and kind of what we're doing. And I know your time is valuable to you, and again, we appreciate you coming on board, and feel free to shoot us any questions that you may have, or if we can assist in any way. But again, from all of us at Investar USA, thank you very much, everybody, and enjoy the rest of your day. Take care. Bye-bye.